After COVID-19, you had a few smart beta strategies that came to the fore. A lot of people were talking about momentum, and you started talking about growth, you started talking about value, you started talking about quality. And now all of these became indices where you could have a passive approach to investing, and these indices would get refreshed every so often 6 months at a time, and a lot of people made money in momentum funds. So what I'd like to do today is to take stock of how these schemes have performed, how these factors, as they're called, have performed, and to talk about what your strategy should be going forward. Mohit Gang, the co-founder and chief executive officer of Moneyfront, joining me now. Mohit, thanks so much for taking the time. Pleasure speaking with you. A lot of people over the last 3 years have even had conversations about whether these factor-based funds should replace active investing because of the cost advantage and because of the way that they've performed. What would you say as things stand right now?
Thank you so much, Alex. Always a pleasure to be on your show. Look, I think honestly, any kind of passive investment, whether be factor-based or a plain vanilla passive investment, has to be given due time, right? Because you are finally betting on a broader index to outperform, and for that to happen, you need a longish time frame, Alex. It's very easy in a 3 month, 6 month, even in a 1 year, 2 year kind of a time frame for any active fund or any active manager to go out and beat the index, but it becomes extremely tough if you extend the timeline. The more you extend the timeline, the tougher it gets to beat the averages, and that's a fundamental statistical law, right? So having said which, yes, it's a fact that for last 6 months to 1 year, factor-based funds and all the factors, barring maybe a low volatility for that reason, all the factors have been typical underperformers and quite underwhelming, and the taste to investors has not been great. Right. So, and we can debate on factor to factor as to what's led to that kind of a thing. But yes, it's a fact that for last 1 year, none of the factor-based strategies have done well as compared to the broader index or even as compared to active styles of management.
Why is that though? Because I look at momentum, and this factor over the last 1 year has been down 19.5%. And is it that in a period of consolidation, you have a factor that depends on that momentum upside tends to lag and underperform?
Okay, so look, I think yes, again, momentum has been the worst performer in the entire factor spectrum, down almost 19%. Having said which, if you were to look at the momentum factor from a long-term perspective, let's say from a 5 year or a 10 year perspective, the returns are outstanding. The 5 year return is around 21% CAGR, and the long-term 20 year return is also, if I'm reading well, around 17.5% CAGR, which is well above the Nifty averages, right? Again, as I said, in a short term, these factors can take a good amount of beating, momentum especially, because it kind of builds up on the price momentum of a stock. Stocks which are running, the whole thesis is stocks which are running will continue to run and run higher and faster. And if anything has taken a beating in last year's Indian market is the momentum piece in the market, because there's been no momentum. The market has been pretty much sideways, has correcting in a time-bound manner. There has not been a very significant value correction, but any and every stock which was a price-driven action stock has taken a good amount of beating, and that's where I think momentum as a parameter has got the maximum amount of it. But my sense on this parameter, Alex, is that once the market comes back into a frantic cycle, which is a frantic up move cycle, which always keeps happening with the market every 2 years, every 3 years, or whenever that happens, I think this is one parameter which will again bounce back the fastest. So one has to be really patient. Again, as I repeat, this is a pretty long-term money. It can't be judged on a 6 month to a 1 year parameter.
Interesting. And okay, so that makes sense on the momentum front. Let me ask you about value, because again, while we've had peaks and troughs over the last 1 year, and particularly in the broader markets, Mohit, we're pretty much where we started, maybe a few percentage points higher for the benchmark, and the broader markets have done a little more than that maybe. But by and large, we've not had too much of a decline, and we've not had too much of an upside either. So is that the reason why a value strategy is not done particularly well either?
This is a little bit of a shocker to me as well. Value strategy being down by almost 10% for last 1 year. But again, look, if you were to uncover the reasons in hindsight, if you see year 2021, 22, 23, I think these were three consecutive years when value was the best performing theme in the market, and value as a style, as a factor style, was at the top of the table, right? And even if you see a longish 15-year track record, I think value will be at the top of the table in all factors, almost like 40-50% of the times, right? So value as a parameter is a good long lasting parameter which says that fundamentally you are investing in undervalued stocks, undervalued companies. Having said which, right now the market in India is such that you're not really bothered about the valuations, though anything which was extremely high has also taken a beating. But there are few tech businesses and few other new age businesses which even at high valuations are commanding a lot of investor interest, right? So it's been a very dichotomous market. Not to say that only value style has kind of upheld its position in the market, so which has not happened, right? But over again, as a long-term track record, if you see 5-year returns on the value fund, on the value theme per se, has been almost 35% compounded CAGR, and the 10-year track record also is astounding. I think it's almost got 17.5% odd kind, which is way higher than the broader market. My sense is value will keep coming back every 2-3 years in a cycle, and again, one has to be a patient holder out there.
While, like I said, and that goes back to the original thought, while equity markets have relatively underperformed, it's not like you have deep discounts or deep corrections. All of that has been bought into because of the kind of money that has been coming through from the domestic side. But talk about quality as well, because generally, and my surprise, Mohit, is that generally when one of these factors or two of these factors underperforms, the third generally does well, but that hasn't been the case.
Oh, bang on, spot on, Alex. I think that ideally should happen. If momentum isn't working, then either quality or value should have worked, and that's the fundamental thesis which you work with. Having said which, last 1 year has been a typical cycle where momentum, value, and quality to some extent hasn't worked. Quality in parts and pieces has worked, value in parts and pieces has worked, momentum overall hasn't worked. Low volatility has worked a little. So just to answer that, perhaps low volatility is a factor which has kind of cushioned your fall to some extent. Quality, I'm really surprised, but if you track last 3 months and 6 months, Alex, I think both quality and momentum are showing signs of great rebound, right? And I'll not be surprised when last month's data come out. I really want to track that. I am pretty sure that both quality and momentum will show a good uptick, right? So 3 months, 6 month data is showing some signs of green shoots, which shows that there is a pickup and there is a bounce back. But yes, quality either for last 1 year hasn't worked well. Only thing which has worked well is perhaps a low volatility.
So we've talked about the major factors, but let's come down to the brass tacks. And you've talked about how on a 3-year, 5-year or 10-year basis, these schemes have actually done particularly much better than they have over the last 1 year. So what should your strategy on an ongoing basis be, Mohit? Can these factors, along with your traditional plain vanilla passives, replace the need for active, or do you do it as a supplement to what you're doing on the active side? And active, in any case, you use as a satellite or to bolster the core of your portfolio if you're doing a plain vanilla passive strategy.
Look, Alex, if you go across the market and ask the market veterans or the great fund managers out there, they will always tell you that you don't buy individual stocks mostly. Very rarely do you buy individual stocks, because it's very difficult to call out individual stocks over a long 10-year, 15-year, 20-year cycle. What you buy is a style of investment. You buy a pattern of investment, you buy a thesis, you buy the brain of a fund manager as to how it is working. So sometimes you buy a momentum style, you buy a quality style, and that index will then keep readjusting. It will keep getting the best quality names, keep getting the best momentum names. Every 6 months it will readjust to the basket of those best stocks, right? So you can't individually as an investor rely on that one thing. So my sense is, not just globally, but even in India, globally though it's a proven phenomena, but in India still there is some time for us to establish that thesis. But my sense is basis over a long period of time, I think investors will have to align their portfolios, a large chunk of their portfolios, into vanilla passives and factor-based passives just to buy these baskets out. And yes, there would be some portion which will always play out in active, because in India we still believe that there are those smart fund managers who can actually consistently beat the markets. Consistency is the key word out here, and that will only get proven in hindsight over a very long period of time. But yes, my sense is the proportion of passives or factor-based passives will keep increasing in every investor's portfolio as we move ahead
So,
over a long.
and of course, you can't necessarily give a one-size-fit-all solution, but if you were to put this in a matrix and you were to say quality, value, momentum, low vol, which incidentally we've not spoken about, and low vol is more or less flat while the others are actually much lower over the last 1 year. What is a matrix? If you prefer one and the other, you don't necessarily have to buy all four, because that might just be like buying the entire market.
Look, there are multi-factor models now, Alex, and there are funds which have come with multi-factor models which kind of tie in both momentum and quality, which means you're buying momentum, but you're buying with an overlay of quality. Though momentum and low vol can't be combined together. So either an investor says that, okay, I want one side of my portfolio in momentum and one side in low volatility to kind of manage the entire spectrum. But my sense is these are all part of your high beta strategies or risky strategies. So if you want a riskier portfolio or something which is more high beta, you go with momentum. You want a low beta portfolio, you go with low volatility. You want a long-term portfolio with more, and you are a guy which is more fundamental investor, then you have to go with value or quality either, right? So momentum is not quality, not value, but value and quality is one basket to me. Momentum is extreme basket and low volatility is another
Great.
extreme.
All right. All right, Mohit, thanks so much as always for taking the time. Pleasure speaking with you.
Thank you. Thank you so much.
All right, viewers, that brings us to the end of this edition of Your Money Matters. Tell us what you think, and do stay tuned. Lots more coming up on NDTV Profit.